Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
News alert, news alert. Cerulli Research is saying the 1% advisor fee is fading. That advisors are going to have to drop their fee. Well, not at Revere. Due to superior service, it's all about the net, not about the gross. Are you willing to pay more for better, higher returns with less risk? In fact, a lot of these hedge funds is 2 and 20. Very wealthy people actually pay a lot of money for good management. Remember, a good friend of ours used to always say, Vanguard is a cheap way to lose money fast in a bear market. Folks, the cost, don't be too tight on the cost. You want to have good management. Strategy trumps everything. Okay? Now, next one in the news articles, Morningstar billionaire says AI finance models lag accuracy. I think there's a conflict of interest there because Morningstar coagulates all the research, and AI can now do that very quickly at coagulating research. In fact, I'm wondering whether Morningstar could be a good long-term short. It's not a lot of these places. Anyway, they scored 20 AI models, and none of the 20 AI models scored over a 50%. They all got an F when asked 500 questions. So the current AI capabilities are essentially exaggerating. It's got a long way to go. That's what they're saying, that it's ill-suited to perform open-ended questions of entry-level finance. You know, that's the girl that just graduated finance, just starting out. Anyway, they got to keep up with the technology. Anyway, it all goes back to strategy. All right, folks, I'm going to go to the mailbag now, and I want to bring you guys under the tent because every year we've got to refile our ADV Part 2A, aka the company brochure. That's the company brochure that you file with the SEC every year. You update with your new assets under management, and kind of your rules and what you do. Are you just pie charts or us, like in Ray J? Or do you active manage? What are your rules? Do you have buy and sell rules? What is that? Anyway, but when we file the first quarter, second quarter of every year, you normally got to get it out by right now, about April, May. You send it out to all of our existing clients annually. So I just sent that along with this letter. So I'm just letting this know. There's loop keeping for the listeners. Okay. It's that time of year again when we have to resend our updated annual SEC filing of our Revere ADV Part 2A, aka the company brochure. Not only does it update our higher assets under management, it describes our portfolio management processes along with our protection services. But if you have been part of the Revere family for a while, you already know this. And you know that we have detailed rules coupled with a strong sell discipline that has avoided every one of these three recent bear markets since 2020. In fact, Protection has never had a bear market. As a Revere client, you have missed most of this recent carnage as the S&P just declined 20% at one point very recently, while we never breached double digit. I think we're down 8.5, maybe 9. Last year, we beat the S&P we beat the S&P with brakes while the S&P had no brakes. Now, you didn't need the brakes last year or a parachute like you did in 2020 or 2022, and even just recently in 2025, but the brakes were there in case you had needed them. That is risk management at its finest, in my opinion. This disclosure has our AUM as of December 31st, 2024, but we are now over 250 million AUM. And we owe it, and Don and I owe it to the Revere team's hard work and your trust. Also attaches our privacy policy, our preferred vendors, 24-hour monitored IT. Okay. Every day, Revere team puts out long, hard hours in protecting your life savings. And as you can see, we take it very seriously. So you simply don't have a pie charts or us passive portfolio that declines 30, 35% every few years. At Revere, we spend very little on conventional advertising and would greatly appreciate any referrals or kind words if you are pleased with the results we have provided you with far less risk than the overall markets. Thanks, and reach out with any questions. So that's what I sent out yesterday, a couple days ago, or yesterday, I guess. And I got a whole slew of them back, but a couple of highlights. I am so grateful that I was referred to you by one of my colleagues, and I am so going to refer you to my colleagues and also my family. Grotection is amazing, all caps. Thank you guys so much. That's one. Then I've got a bunch of others. Thank you. Thank you for a job well done. Thumbs up, all that kind of stuff. All right. So I got a whole bunch of those. But then I just got one this morning that was very interesting. I'm going to read that. Hi, Dan. If permitted, you should consider putting your ADV on the website. You can't get much better advertising than the work and protection that document details. Can that be shared by me if someone asks me about your firm? I'm not sure about privacy issues, but I see nothing in that discloses anything that couldn't be public information. Actually, it is public. It's supposed to be public. I saw Ted using Deep View a couple times in the video. I didn't realize it was formerly another research tool you use. I became a founding member of Deep View last year as I was so impressed with what those guys are doing. They are sharp guys. I absolutely love the relative strength tools. Best wishes, BW. Me. Ted helped and interned at Trader Lion and is an expert at Deep View. Ted, I put Connor Ted, but Connor doesn't really use it. Ted uses it actually as much or more than Market Surge and other platforms, but we have a few different platforms. ThinkPipes is really amazing too. Not a bad, meaning the ADV, not a bad idea. And you can absolutely share our ADV as it is our public company brochure that we were actually required to provide to any interested parties in joining to Revere. I had to send out 2 this morning. There is a link to the SEC website from our website, but that is even a better idea, just simply posting it on our website. Thanks, and have a great weekend, Dan. All right. Folks, so with that backdrop, I'm going to kind of explain something real quick. So with the SEC, we get audited about every 3 or 4 years, every couple of years. And in our business, we need to get, advisors need to get audited. Anyway, this last audit, it was kind of funny. So this last audit, 2 audits ago, they came in and the girl's explaining, this is right after COVID, it's 2021. And she explains, she says, she starts gathering the data and I give her a transaction summary. And she goes, oh my, you must be awfully risky. And I said, I'll buy it. All right, why is that? She said, well, because look at this turnover. You must have very high turnover. I said, oh, yes, it's very, very high, extremely high. And she goes, oh. And I said, but explain to me this, because I don't quite get that. My simple mind, I know that the SEC, you guys think that transactions is risk. I think that risk is when you're in stocks, when you're in the market, and you don't have risk if you ignore inflation, when you're in cash or in the money market. Call me small-minded. And, I'm a CFA, I know trainer and, Sharpe's ratio and all that stuff, but my clients really want to know, how much money did I lose? What is my drawdown? So, ma'am, answer me this. During the COVID bear, the market high to low was down 35.5%, and we were down like 13.5, right? Now, year to date, because January and February were up pretty big, like 10%, year to date, it was down around 25%. So you got to be careful what intervals they're picking, cherry picking, right? We were down 8.3. All right. So basically, we were down about a third as much. And by the end of the year, we had beaten the S&P handily. So, ma'am, can you please tell me why we're more risky if we went down a third as much? How are we more risky if we lose a third as much money? By the way, we did that in COVID bear, same thing. This year, same thing. How are you more risky if you go down a third as much? Gosh, I still can't get an answer. It bugs me. Anyway, so fast forward, next audit. This is just a year ago or something, and he's looking over and he looks, and this guy's an SEC attorney. Now they said in the big guns, this guy's an SEC attorney, and he goes, well, how are you assuring best execution for your clients? And I looked at him and I said, you mean ever since the SEC actually gave free trading to Schwab and then and everybody had to follow suit? So now, instead of getting charged $4.95 and making Schwab or Fidelity give you best execution, you're getting a good fill on the price. They got to go to all the exchanges, and whoever's offering the best price is where they got to go. Now they're giving you free trades, but they're actually selling your order flow to the exchanges. So it's the highest bidder. So you don't know whether you got a good fill and the implicit cost that you don't really know about only cost you $2, or you got a crappy fill and it cost you $20. I'd rather have the 495 and not worry about it and know that they're getting the best execution all the time. Nothing is free, folks. The trades are not free. They're not free. Okay? Nothing is free. Your parents were right. Anyway, so now with the trades, the client doesn't know whether they're getting a $2 fill or a crappy $20 fill. So now you're leaving it us to monitor that. You mean that, or how are we doing your job for you, the SEC's job, to make sure that the clients get best fill? And he kind of looked at me, and I thought, ooh, might have overstepped. And then a smile broke. He kind of smiled, and he said, well, I agree with you. We shouldn't have done that. We should have, I didn't agree with that decision, but we did it. And you're still required to assure best execution for your clients, right? And he said, so what advisors do is at least once a quarter, you got to go pull 3 or 4 trades off of the trade blotter, off the thing, and then compare them to your timestamp. The same time, you look at your trade, and then you look at the tape and the timestamp, and make sure it's a competitive trade, to make sure it was a good price. And you got to do it at least once a couple times, for 3 or 4 trades a quarter. But most advisors do it once a month. They do it pick a couple trades once a month. So I started last a month, 3 months. Man, that's slow, man. We work in real time. First of all, we got 3 or 4 live trading platforms that we're looking at. So before we even go to Schwab's trading platform to put the trade in, we already know how many shares we want, what we want. We know whether we got to do a limit order, a VWAP, volume weighted average price, market order, call for an upstairs bid, or whatever. We know how we're going to do the trade. And first of all, everything we do is so liquid, right? It's got $100 million daily dollar volume that the spread is only going to be a penny or two. It's very tight. So we know what the fill should be anyway. But if I get a bad fill, I'm on the phone with Schwab in 30 seconds wanting to know why they gave my clients a bad fill. And if they're not going to give me a price improvement, they need to have the compliance officer at Schwab call me and let me know why and put it in writing, not because I'm going to have to file it in my file of bad fills to give to the SEC, and then I'll blame Schwab, not me. And both times, that's only happened. It's very rare. It only happens a couple times. Both times I got a price improvement. Is that what you're at? And he goes, oh, well, I didn't even see that in your SEC, your company brochure, your ADV Part 2A. Well, you didn't really put much. It's kind of vague. And I said, look, and he said, you kind of staying vague because you've been told that, haven't you? And I said, well, every advisor and everybody I've ever talked to says, don't get real detailed, because it leaves you open. He said, actually, that's wrong. This is an SEC attorney. He said, look, you're not doing the anti-money laundering. You're leaving it up to Schwab, right? I said, yeah. He said, take it out of there. You're not doing it. Don't leave yourself open. You want to put in specific rules. You want to put in the specific things that you guys are doing so that this is your company brochure. This is your marketing tool that the SEC has approved that you can use to give to people. And so the more you put in there that you're actually doing, don't put it in there if you're not doing it, but if you're doing it, put it in there. So in any event, our most recent last 2 company brochures have actually got a lot more red meat and a lot more stuff in them than previous ones. Well, probably got bad advice, I guess. But in any event, our company brochure, our ADV Part 2A, is now got a lot of our rules and a lot of our stuff. And if you'd like that, just email me, dan@revereasset.com, and I'll be happy to send it to you and you can look at it. Right? I'll give you whatever you want. I'll give you whatever you want. Now, with that said, I want to go to the team, and we're going to talk about the actual processes of what I described in the ADV Part 2. But here's what Part 2A, here's what I'm going to tell you. If you're watching our videos every night, so every night, if you just go to revereasset.com, up in the top right-hand corner, there's a subscribe button. I'm going to redo the website, but make sure you get your name in there and it accepts it. And once you get it, you'll get our daily market insight every night the market's open. And this podcast in Friday, if you're on YouTube, you get it Friday at noon or 1. If you get it on the email list, through our website, it'll come Saturday morning. So the other way to get our stuff is YouTube. Just type Revere Asset, just Revere Asset, and then you got it. So there's 2 ways to get our stuff, but we put out more content than any advisor I'm aware of on the planet, not in the United States, in the world. We're putting out content every day. The market is open. We're doing a 10-minute video at night telling you what we're doing. We do this podcast once a week. And then Ted, Connor, and Todd are doing weekend roundups and weekend stuff. So our stock nerd community, we got a whole group of stock nerds all contributing, putting stuff in. In any event, we're very serious about this. So when you listen to these guys, listen to them. Does your advisor sound like that? Or is he talking pie charts or us, asset allocation with some random date rebalancing? How do you know December 31st is the right day to rebalance? You got 1 out of 365 days of being right. There's a better way to do it. Follow price, follow the trend. Price is truth, no exceptions. With that, Don?
Let's go, Dan.
Giddy up.
Hey, Dan, 9 steps from bottom to bull. I've got a revisitation of this process, and we checked another step off yesterday when the S&P 500 and the NASDAQ 100 regained their 50-day moving average. So started with regaining the 8, then the 21, had an O'Neill follow-through day, 2 of them, in fact. No distribution days after those follow-through days. The ADMA crossed up through the 21 and now regaining the 50-day moving average. Next thing we want to see is the slope of the 50-day turn positive. Then the 21, not sure which order these will come in. 50 slope, turn positive, 21 EMA, cross up through the 50. That's basically the opposite. It's basically the golden cross, the opposite of the death cross that we just saw with the 50 breaking below the 200, and then regain the 200-day moving average. So here we go to the charts, and you can see there's the regain of the 50-day moving average yesterday and follow through strength to the upside. Notice, however, as I said, the slope of this 50-day moving average, we need to see this flatten out and then turn up. Here is the green line.
Yeah, it should do that. See how those 2 short-term where you're pointing right there is starting to hook up pretty strong, so it would stand to reason the 50-day would hook, right?
Right. Yep. Assuming price continues to go higher.
Right.
And then we're coming into this black line, which is the 200-day moving average. If we go to a weekly chart, you can see it's the 40-week moving average. Also have declining shorter term moving averages here. There's going to be a lot of resistance. Theoretically, there'll be a lot of resistance when we come into this level. However, we're looking at 9 straight up days on the S&P 500, and that is an extremely rare event. We've been mentioning that don't pile in for about 3-4 days now, but don't argue with price. It's just continuing to go higher. So no matter what we think, we're following along with the trend of the market, and this continues to be very bullish action off of the lows. We've got participation with leading stocks. If we hold these gains today, this will be our second close above the 50-day moving average on the S&P 500 and the NASDAQ 100. You can see the NASDAQ 100 coming right into this 200-day moving average as we speak right now, which is a little bit after noon Eastern time on Friday, up 1.77% on the day. So we'll see how we close. We'll see how long it takes for these moving averages to turn back up. And if we test them, if it holds, there's obviously going to be pullbacks. You don't happen. The market doesn't go straight to the moon forever, but this is all with the media screaming about how bad these tariffs are and everything is going to come crashing down. They haven't announced any tariff deals yet. China indicated at some possible engagement overnight. That was one of the reasons for the gap up this morning, along with a strong jobs report. That also flies in the face of the narrative of everything is coming crashing down. And don't pay attention to the news. Pay attention to the action of the market, and keep simply don't overthink it. We if we're on a call and somebody says I think, they know that I'm cringing. I mean, on it, because we don't want to think. We want to interpret what is going on and act accordingly. And you can't complain about this action at all.
The most dangerous words you can hear a visor say is "I think."
Yeah, really. So, there's just another alert. The alerts to the upside keep firing off. Don't know what to say, Dan, other than follow the trend. That's what we do.
And think about it. Think about it. The media, the last week or two, has got you all in a frenzy and a terror about these tariffs. They've got you fearful that the sky was falling, it was coming to an end. And just remember, just a week ago or a week and a half ago, everybody was talking about the death cross. Remember that, Don? The death cross is coming, and it's Armageddon. Folks, the death cross is a very lousy indicator as far as probability. Like it's I don't know, it's like 30, it's very low percentage. It's not successful, meaning the market crash often. So it's not really a strong indicator. It doesn't really tell you much, I don't think. What do you think, Don? Do you use that?
Well, Todd did a nice, a great presentation on it.
Well, I mean, if he keeps following through and it breaks, it's dangerous. I'm not saying it's not. If it actually starts to keep going, then you definitely got to. I'm just saying, as far as an indicator, it's not as accurate as others.
Correct. It's not. Nothing in the market is accurate 100% of the time.
Yeah.
And just follow the trend. Honestly, that's about all. It's what we do simplified here at Revere. The difference is we follow it over 3 time frames and add in what our leading stock's doing to outperform when the trend is our friend.
Right.
I don't really have a whole lot to add. No tremendous insights today with that. It's just we've been following our plan, incrementally adding. And, the buys are working. When they work, you stick with them or add more to them. And
here's one
as
thing.
Ross Perot said, it's at sample.
Yeah, here's one thing I do want people to realize. And listen, you've always got to be supple enough in your mind to realize the market could easily go up 30% or down 30% in a month from here. If you don't understand that, you're not flexible enough in your mind to understand markets, especially on the downside. When the markets sell off, the big losses, the bear markets, 35%, they happen in a month or two. It doesn't take 6 months. It's not a slow, steady, it's a cliff. That's why they always say it's an escalator.
You're a little high on your percentages there. The only time we've gone down 30% in a month was with COVID. It's a process, but the process happens in the same order every time. Break the 50, break the 21, break the 50, break the 200.
Yes.
It can happen quickly or it can happen slowly.
Yes, but you got to be ready. Look, economic crisis 2008, that happened in a couple months. I mean, and then it had a recovery, and then it had a double waterfall. But those 2 waterfall events, those 2 big drops, those were a couple months each, right? Weren't they? If you look,
they were, but it wasn't 30% in a short period of time. COVID's the only time that's happened.
Okay. All right. Fair enough. I'm just saying
it was spread out over 2 years. It was spread out over 2 years in 2008. 2007 to 2009.
Yeah.
Well, let's go to the fellas, and we'll start off with a real nice PowerPoint with Todd. And talking about breadth thrusts. We've alluded to this a couple of times. Also, a lot of people arguing with these breadth thrusts on Twitter. We always like to see people giving a contrary opinion when we're saying something, because if everybody's leaning in the right direction, nothing is going to work. But a lot of people questioning it, but market has continued to go higher. Take it away, Todd.
All right. Here's the opening screen. This is basically what happens. The pendulum swings too far to the left. Everything gets oversold and washed out. And then all of a sudden, the tide turns and the thrust comes on. And this is why breadth thrust is very rare, but very accurate. It's been tracked all the way back to pre-World War II, but the real success has occurred post-World War II, where every single one of them has been positive 6 months and 12 months out. But what I wanted to do today is go through and look at what happened in the more short to intermediate term before that 6 and 12 month period to help perhaps gain some insight on how best to trade that period. All right, let's start with the first period that we're going to cover. This is the S&P 500, and this was the bottom of the great financial crisis. The market up to this point had dropped 57.74% going into this, and we bottomed at 666.79, and we started off with a follow-through day on 312, which I've marked it by the first wedge, and then the second wedge was the actual breadth thrust. And you can see we were well below a declining 200-day moving average, which is the black line. On this particular follow-through day and thrust, this was a perfectly successful one. We didn't have any pullbacks. We broke straight through the 200-day moving average, and the only thing we really did is rode the backside of the 200-day moving average for a little while after that, but we ended up continuing for a long period of time after that. So that was a very good bottom. We had a pink rally day right at the bottom and a quick follow-through day. And incidentally, in all these instances, we had fairly quick follow-through days that occurred too. So if we go to the next period, this was the October 14th, 2011. And this ultimate drop was about 21% deep intraday. You can see before the follow-through day and the breadth thrust occurred here, we had a huge pink rally day as well on that situation. The follow-through day came on a little bit after this particular breadth thrust, but in this particular period, we were a little bit choppy, and we ended up breaking through the 200-day moving average afterwards, but then we pulled back about 5% from that ultimate high through the 200-day down to the low. So we did undercut the Zweig breadth thrust as well as the follow-through day in this particular example, but then ultimately went on to turn into a very successful trend. If we go to the next screen, this is the October 8th, 2015 breadth thrust. And this was about a 12.5% drop. During this time, we had the China currency devaluation, oil had collapsed, and I believe there was fear of a Greek debt fault going on at this time. But in this particular case, we ultimately went straight up through the 200-day moving average after the follow-through day and the breadth thrust. Incidentally, we also had a pink rally day here at the bottom, and went on to break through the 200-day, but then chopped around a little bit and broke back through, undercut those lows later on. But ultimately, the thrust went on to break right through the 200-day moving average. And incidentally, on every single one of these, I noticed that we ultimately went through the 200-day moving average. But this was one example where we did eventually come back through and undercut lows down the road. So if we go to the next slide, this was January 7th of 2019. And we had dropped about 20% also from highs to low into this January-December low area. And this occurred because of the Fed rate hikes and fears of a slowdown happening in a recession. However, we quickly had a follow-through day on 1.4 as well as a breadth thrust on 1.7. And in this particular case, we went right through the 200-day, backed off and undercut it down the road, but this was a very successful one that never looked back. And finally, in the current period, we're in the current period now. And this is cut off the screen a little bit, but we had a follow-through day on 4/22, and the breadth thrust occurred on 4/25, and we had a follow-through day as well. So this has been very strong. Again, we're approaching the 200-day moving average, and at this point, we don't know whether we're going to, back off go a little bit above that 200-day stop here and back off. But in general, in every one of these particular examples that's occurred since 2000, we were able to recover the 200-day moving average eventually pretty quickly after the breath thrusts. So again, we've got a lot of power in this particular rally. We also had a Whaley breath thrust, which is another type of thrust, and the market's gone on and we're quickly approaching the 200-day moving average. So that's just a glimpse into what's happened during these past breath thrusts below the 200-day moving average. So just wanted to go through that.
Okay, so Todd, I want you to put your Todd interpreter on and put in very, very, very simple, plain English. So basically, when you're under the 200-day moving average and you have a big, quick sell-off within 10 or so days, you're really looking for an oversold bear market rally. That's kind of so. What sets up the Zweig thrust indicator? What are the parameters? It's got to be a 10-day collapse, and then what are the few variable setups?
It's basically it's an overbought, oversold indicator for the stock market invented by Zweig, and it basically his oversold indicator goes to below 0.4 to overbought of 0.615 on the overbought, oversold indicator within 10 days.
Got it. And it's been very accurate when it sets up. It's not that common, but when it sets up, it's very accurate.
Yeah, we've only had, this is the 9th one since 1984.
Right.
So
okay.
We've had 9 of them in this millennium, and every single one of them has been positive 6 and 12 months later. And really every single one of them has been positive a month later. And over 3 months, there's only been 2 times that it's had negative results.
Got it. So the probability is tilting in your favor significantly.
It's a big indicator.
Yeah.
And when you get good price action, good follow through days with it, you see a lot of these bottoms were all pink rally days, which again, if you want that interpreted, that basically means that the market made a low but closed either green on the day or more than 50% up from the lows of that day.
The upper end of the range.
So it allows us to start the follow-through day count one day early.
Right.
And most all of these had the pink rally day at the low, which we also had a pink rally day at the low here, I believe. Didn't we, Don? Did they count that as a pink rally day on the low?
I believe that they did. Yeah.
That's pretty close. That's pretty close to halfway, right? We're going to get the ruler out. Teasing.
But, there were a lot of funny dynamics in this period where we had Good Friday and the volume was, a little bit tricky. So we didn't really get a follow-through day until 4/22, which was
there was a big options expiration, massive volume day that skewed the Monday following that. There was a lot of things that you can't just look at the chart and tell. There's nuance with everything in the market, and
right.
That's absolutely the case.
Right.
Great presentation, Todd. Appreciate that. Let's go on to Connor, who's talked a little bit in a video about this topic this week, and it's a tool to add to the toolbox for identifying potential leadership early. Take it away, Connor.
Yep. Thanks, Don. Yes, I think one thing that we're always trying to find, right? We're trying to, find more edge in our trading and just trying to expand the toolbox for different market conditions, because as we know, certain setups work better in certain conditions. And I think making a playbook that has different setups, different criteria for different markets is really important in how and it's basically the pursuit of always trying to improve at Revere. And one specific setup that I want to talk about today is something that's not in the classic playbook, and that is 3 weeks tight pattern off the 40-week moving average And it can be a little bit more broad as well, generally just tightness at the low end of the base. And so HIMS, I wanted to bring this example up for the episode today. I talked a little bit about it on Tuesday, also got some luck on this one. But if you go to the weekly chart, Don, and so, well, first of all, before I get into this, I'll just talk about kind of what I'm looking for in this setup. And so number one, there's a couple ways to play it. First thing is market needs to pull back. In a strong market, you're primarily going to be buying breakouts, buying strength. But once the market pulls back, many leaders follow and pull back with the market. The M in CANSOM is so important. So you have your list of stocks and the market's pulled back. You're seeing some of the names that you like have pulled back. So the next question is, how can you get in? How can you find a low risk entry? And I found that some of the best stocks like to pull back to the 40-week moving average. It's exactly what HIMS did. And then they get tight, really tight. 3 weeks of tight closes is a typical characteristic that I found. And to me, that signals that institutions are stepping in. They're trying to buy as much as they can over a couple weeks to a couple months. And that's where you start to get those tight closes. Volume could be increasing, but price isn't moving. And that's really price kind of telling you, hey, this might have a floor. And that coincides with a key moving average as well, like HIMS had. And so this was a perfect example of that. And then it had a catalyst on Tuesday. They partnered with Novo Nordisk, and that prompted the gap up. But again, as technicians, we always like to say is that it's not a coincidence that news comes at good setups. And you see that with breakouts, and you sometimes see that with pullbacks. Is it a coincidence that HIMS was at a really good technical low risk spot and then news hit? Pie charts are us would call that voodoo, but technicians, there's more to it. And so, yeah, you can see
voodoo as they lose 30%.
Yeah, exactly. And so, yeah, this had that positive catalyst, and now it's moving back above all key moving averages. And for the position and turbotection, we still have a piece of this, and they report earnings on Monday. So this HIMS would lie under the category of a market pullback setup. And the next example I wanted to show is Kava. And another thing is you don't necessarily have to have the market pulling back either. If you go to the weekly here, sometimes stocks just make very big moves and they pull back. The market could still be going higher, but leadership ebbs and flows. Some sectors are leading for a certain period, and then they go in a period of basing consolidation. And Kava was one of the strongest stocks in 2024. You can see that massive run that it had. And then at the tail end of 2024 into early 2025, it started pulling back to the 40-week moving average. And then you can see 3 tight weekly closes off the 40-week moving average. And then it saw a nice pop, 20-30% move. Obviously, it did end up rolling over, but that was just a function of the market with tariffs, DeepSeek. Nothing was able to hold up at the highs. But again, as O'Neill says, not every trade's going to be a monster TML. So taking 20 to 30% trades is a great strategy. And that pullback to the 40-week also was the first of its run since it broke out of that IPO base. And so, like I mentioned with HIMS, the big institutions, they can't really buy breakout. So they have to get in when the price pulls back, and they can get in over a period of weeks to months. So Kava was a good example. And then the last example is Tesla. This is a little different. This characterizes the example of tightness at the low end of the base. And this occurred in June 2024. And not only did this have 3 weeks tight, this had 5 weeks tight. And this was below the 40-week moving average. But again, I'm trying to paint the picture that when you start to see tightness at the low end of the range, that could be a sign that the stock's trying to bottom out and trying to get back into a stage 2 uptrend. And it's not necessarily a buy signal all the time, but again, it's just a signal that, hey, maybe you want to put it onto your radar again and look for a low risk entry, look for a setup that you're comfortable with. And again, it best works for strong, fundamentally backed companies, because those are the ones that over over decades to years tend to stay in uptrends. And when they pull back, that is when big institutions like to get in. And there's always some signs that the chart can show. And I found that 3 weeks tight or general just super tightness at the low end of the base or the 40-week moving average can be a good sign to potentially try a starter or just put it back on your radar. Because at the end of the day, we're not looking for the best price. We're looking for the spot that we can get in with the lowest amount of risk. And that's
Great stuff. Also notice the dry up here after the pullback. So we're pulling back hard. You see several times above average volume. Then big volume came in when it was trying to come off the low, and then in that tight area there, look how dry the volume was while it went sideways before making a slingshot move higher up off that low. Great stuff, Connor. We talked in the past about a tightens off the 200 way of keeping an eye on big, well-known stocks and how institutions come in and like to vacuum up the shares like they're getting something on sale there. And this is just another great example of that saying and putting it into practice. Excellent stuff. Going to be interesting to see what happens with HIMSS and earnings on Monday.
Yep. Excited for that.
All right.
one.
Yes, we're going to segue over to Tedders now, who has a very interesting alternative way. We're usually looking in the U.S. at the best stocks and the best sectors, but this has been a year where international stocks have outperformed U.S., and he's going to focus on Latin America. Take it away, Ted.
Thanks, Don. Yeah, definitely very much. The Trump administration, with their recent policies, has really shifted just global trade and geopolitics. And that's pretty much the central part of the Latin American thesis. Before I talk about like the politics, geopolitics, and just some other valuation stuff with Latin America, I want to go over the charts first because I want to put most emphasis on the chart. Because it doesn't matter what the bullish thesis or bearish thesis is. If it's not confirmed by price, it doesn't matter. And really, international foreign emerging markets has been quite unfavorable versus the US in the past 10, 15 years. And if you own that, like in asset allocation, that took up like, let's say 10, 50% of your portfolio, that was only a drag on your returns. But let's start with the ILF ETF, which is the Latin America 40. I believe it's the top 40 countries of Latin America into one ETF or one composite. If you want to go on the weekly chart, Don, once again, probably sounding like I'm repeating myself, but stage analysis is like a central part of my process. And you can see Latin America was in a downtrend below the 10, the 20, 30, and 40-week moving averages. All of those bearishly aligned and sloping downward. Then, like I said, when the rate of change of the downtrend slows down, price starts oscillating in between the moving averages. Eventually, those moving averages flatten. And now, last week, we had that stage 2 breakout. And if you can draw that horizontal line across, Don, yeah, perfect. And now you can see you have the stage 2 breakout. We retested it, held. And so far, it's looking like it's confirming that breakout. And if you highlight that volume, Don, there's that icon as well that market search shows. That is the highest volume in this entire base. If you just look back across for over 2.5 years, you don't see a larger volume bar than that. So that's supporting the stage 2 breakout, and accumulation is a really good sign. So right now, we can say that Latin America is just starting an uptrend, and this is a great quote unquote investor buy opportunity, or even a trader buy as well. And then the 3 individual countries that I am most favorable on, the first one we've actually bought in turbo, which is Mexico. You can see here, it actually looks stronger than the ILF on the chart, and we had that stage 2 breakout as well. And we retested it perfectly, and that's the day we took some shares. Like when you turn previous resistance into support, hold, and confirm upwards, that is a great indication that the trend has turned. So this is Mexico. The next one is Brazil, and it's working on its stage 2 breakout as well. And I'm pretty sure today it's starting to reconfirm that stage 2 breakout level. Yep, perfect. It broke above that horizontal pivot as well as the flattening 200-day moving average, back tested it, and now it's confirming to the upside as well. So these are looking really good. And the final one is Argentina, that has been running for over a year after Javier Milei was elected into office. And there's always a saying I like to say, and I probably took it from someone out there, but capital moves and flows to where it's treated best. And when Javier Milei came in, he pretty much instituted austerity, which is cutting the excess out of government, cutting unnecessary government programs, lowering taxes, slashing regulations, and free markets. Capital loves all of those properties for a government. So you see that price confirm, really nice uptrend. I think Argentina almost went up 100% since then, 80 to 100%. So that was a great move. And even on this recent just global market crash, if you will, Argentina quickly reclaimed a rising 200-day moving average, didn't even really spend that much time underneath, and quickly shot back up into almost new all-time highs. And it's pretty much acting near perfect right now. Just needs to build more of a right side, some symmetry, bring out some more supply, and then this looks really good over that 90 spot, or even 85-ish to 90. So this is the final ETF. As you can see, we are buying stocks in uptrends. We're turning into uptrends. We're not just going to bottom fish and try to catch a low. And on to like more of the fundamental macro part of the thesis. Like I mentioned, Javier Milei, there is a shift in the entire world, but we're specifically concentrated on the Western side of the world in Latin America right now. And yeah, there's a shift towards free market capitalism and away from just a government-centric socialism or just bigger government. And yeah, capital, free markets, and investors love those features. So deregulation, less taxes amongst many of the Latin American countries. We know there's a shift. A shift happened in Argentina. There's talks that the new candidate in Brazil is heating up and looking to take over as well. There's talks that Colombia is shifting towards more free market, conservative spectrum side of the political spectrum as well. We saw some Colombian banks do really well off that news as well. And just another statistic, the average fiscal deficit is currently at 4.8% in Latin America versus 8.5% in 2020. So the governments are getting their deficits under control as well. So that's another attractive feature for investors into Latin American bonds and debt as well, not just equities. And then when I started this segment, I talked about Trump reordering global trade with the tariff wars against primarily the Eastern countries and China. And this is for national security reasons, because China is our main competitor for the number one position in the world. And we want to pretty much, the theme is that we want to either reshore, especially the high end and advanced manufacturing like AI, like the AI infrastructure and chips, aerospace and defense, or shipbuilding. Or if we can't reshore that, at least, and there's this term called friendshoring or nearshoring, which is bring those manufacturing plants or industries back near the US, for example, like in Mexico or some of these Latin American countries as well. So there's many of these cross currents that are supporting the Latin American thesis. And then on top of that, there's opportunities, like we saw Trump sign some executive orders for rare earth mineral mining, and there's a lot of that opportunity in the Latin American countries as well. And then finally, historically, Latin American equity assets have been undervalued, and the sentiment around Latin America has been extremely poor. And all of these factors kind of combine, along with the technicals, turning out of a downtrend into a new uptrend, presents a pretty decent case for Latin America, and it could present some less correlated returns to the traditional U.S. markets and indexes.
All right, great stuff, Ted. Dan, take us on home.
Man, I'll tell you what, folks, I like that because you know what? Ted is showing you where the good fruit, the good countries, the good emerging markets are, not just a whole basket of good fruit and rotten fruit. Do you have a bunch of rotten countries in your emerging market fund, or are you selectively picking the best of the best? When you go to the store, do you buy rotten fruit to get a balanced diet? Don't get rotten stocks to get a diversified portfolio. In fact, you just want just enough diversification on the way up so one Enron or line on the books doesn't kill you. But on the way down, when it's really getting ugly, you don't want diversification. You want cash or money market or something. You don't want diversification because all the correlations grow together and it goes down together. Folks, listen, if you liked what you heard, please tell a friend, tell a neighbor, just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button, and you can put your stuff in there, and you'll get this podcast on Saturday morning and our daily market insight videos every night the market is open, right? Then if you go to YouTube and just go type in Revere Asset, just Revere Asset, and hit subscribe, Zach's going to have this thing posted in about an hour. It's about 11:40 right now, Central Time. He'll probably have it out by 12:30 on YouTube. That's how the stock nerds get it. So there's two ways to get our content that we put out almost every day. We're the most transparent fiduciary advisor in the world that I'm aware of. And you can always call us old school at 855 Real Wealth. We'll talk to you next week on Your Money, not Wall Street's money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.